All right, the first thing I'm going to talk about is the classified balance sheet. Why don't I have this label here? So this is a classified balance sheet. And these are the classifications that we have for them. Talk about each of these in a second. We talked about these a little bit, but we're going to go a little more in depth to them. Now, the idea behind the classified balance sheet is to kind of put things that are similar together. Okay. Oh, wait a minute. I need this. All right. It's sort of like, if you go to a grocery store, they put things that are similar together. So if you want to buy Cheerios, you go to the cereal aisle. Now, everybody knows that. And notice I didn't tell you what store. It doesn't matter what store. Every store that carries Cheerios is going to have them in a cereal aisle. We all know that. It's categorized. That's where you're going to find it. We do the same thing on the balance sheet. We put things that are similar together so that people know where to look for them. So just like trying to find cereal in the grocery market, you know where to go. On a balance sheet, you'll know where to go to find certain accounts or types of accounts. Current assets are assets that are going to be turned into cash or used within 1 year. So these are 1 year or less. Write that in. And the same thing with current liabilities. Again, we talked about this a little bit, I think, before. We did the statement of cash flows. So these are all short-term stuff. This is the current assets and the current liabilities are short-term. Actually, change the coloring here. Let's make that make them green. The rest of these are all long-term. So the rest of these are all more than 1 year. Not your year. So these are more than 1 year. So long-term investments, land, we'll talk about that a little bit. Property, plant, and equipment, land's going to last for more than a year. Buildings will last for more than 1 year. Equipment will last for more than 1 year. These are intangibles. These are things that don't have a physical being, but copyrights, for instance, record companies or movie studios and stuff. Goodwill, which is kind of a wacky one, but trademarks, franchises, patents, those are all things that the value is not tangible, but it still has a value. Copyrights are very valuable, or they can be anyways. Okay, and same thing over here. We have the liabilities, and these are all short-term things. And these are things that will be paid off within 1 year. Long-term liabilities are more than 1 year. So anything be more than 1 year will be a long-term liability. And then the stock down here, this is really long-term. In fact, theoretically, it's infinite. Stock can go on forever. So these are very long term. These can be like say forever, basically for the company. Okay. So today we're going to talk about depreciation and allocation of cost. Now, I think I'll hold off on the allocation ideas for a second here. But a few ideas, though, are that land is generally not depreciated. And what we mean by that is, okay, for instance, let's say you buy a house. When you buy a house, actually what you're buying is the land. Oh, and there happens to be a house on top of it. So the land is actually what you get your deed for. It's the deed for the property. And there happens to be a house on the land too that you own with it. So the land itself is theoretically going to last forever. You may tear down the house and put up a new house, but that land is going to be the same. So we don't depreciate land, but we do depreciate things like buildings. Buildings don't last forever. Usually they, at some point in time, they get torn down, get, destroyed, fire, whatever. So the land lasts forever. Buildings generally don't. So we depreciate things like buildings, equipment, all that kind of stuff. We depreciate those things, but land we generally don't depreciate. Buildings equipment, we do depreciate. There's 4 methods, and I screwed up the spacing here. Fix my spacing. These are the 4 methods that we have. In this class, we only go over these first 2, which are, I think, the most, well, they're the easiest, and they're also probably the most relevant. And then intangibles are these things over here. So the intangibles we're talking about. Turquoise. These things. And these a lot of times don't last forever. For instance, a patent lasts for 20 years. You create a patent, you have the right to use a patent for 20 years. After 20 years, anyone can use it. Copyrights don't last forever. They last a long time. I think the copyrights are the life of the author plus 90 years or something like that. So, they go on for a while, at least 90 years. But again, at some point they become, they become worthless. And one of the things about copyrights, software is generally a copyrighted thing because it's coding, it's writing, in a computer language. So a lot of times those things, even though they would theoretically last for decades, a lot of times things like computer copyrights, you amortize those over a much shorter period because, who wants a 20-year-old software program? Probably can't even run it. So there are some copyrights that even though their legal life is really long, their actual life is pretty short. Okay, so let's jump into what we're going to do for the class. Okay, determining the cost of an asset. So seeing what the cost of an asset is the first thing we're going to do here. And we got a problem underneath here, but I'm going to jump over here to this other side just to kind of go over the kind of things that we have. Okay, so what goes into the cost of the equipment? The purchase price, whatever you paid for it. Shipping costs, including the insurance. Modifications to the factory and trial runs. These are ones that are not as obvious, but they go into it. So if you have to modify the factory, you can't get the piece of equipment through the door, so you break out the door, get the equipment. When you do that, the cost of doing that goes into the cost of the machine. So if you have to make modifications, and then also trial runs to make sure that it's up and running correctly. Anything that it takes to get the piece of equipment up and running correctly is part of the cost. And equipment is depreciated. It doesn't last forever. Although I was on an audit one time where they actually had equipment. It was actually electric motors that went back to 1928. They had two of them. It was a assembly plant for Navistar. Giant motors like the size of this room. And they cost like $2 million to rebuild, and they would just rebuild them all the time. But they're literally, they were from 1928. Okay, buildings. Buildings are depreciated. Buildings don't last forever. And they have a number of things going there. Any of the construction costs or modifications go in there. Architectural fees. Construction legal fees go in there. So any lawyer things you have to do to get make everybody happy, those go in there. Building permits. And this is the kind of strange one. Interest incurred in the construction. There are some rules that if you're paying out of the construction out of your own pocket, that you could actually use that money to pay off your debt. And so they said, okay, well, you're giving up paying off your debt, so there's interest that you're paying actually on this money, because that money could be used for paying off this debt, so that gets put into the cost of it. It's kind of a wacky formula. It doesn't happen all the time, but I just throw that in there because it is part of the cost of it. Sometimes the interest incurred during the construction. And that's one of those weird things that they like to throw on tests and stuff. So it's in there. And creating the building foundation, in other words, the foundation that you're going to put the building in. Okay. Land is not generally depreciated. And so land, we have the purchase price. That's my new word. The other teachers just use the same old words. I make up my own. So the purchase price goes in there, but there's some other things that are a little bit more unusual. Removal of old structures and buildings. So if there's an old building or something, it has to come down. Old building, old parking lot, whatever. That's part of the cost of the land. General leveling. So now this isn't for making the foundation, but if you're just trying to get the place flat enough that you can start planning to what you're going to build on it, that's part of the land. Payments of tax liens, legal fees, insurance, payment of tax liens. This one actually can be kind of common. Sometimes you buy a piece of land, especially if someone has moved out or something, maybe someone went to an old folks home or something, and the land, the house is there. They may not have paid the taxes. So sometimes you have to make up paying for the taxes. When you take the land, you say, okay, there's back taxes of 2 years. Well, those back taxes have to be paid. So that's part of the cost of the land. So any of the costs that go into buying that land is going to be put into it. Legal fees, title insurance, those are all part of it. Okay, and it goes a little bit into this in the textbook. Long-term assets. If you, and we're not going to do. I don't think I have any problems on this. But here's the idea of it: is that if you're doing regular maintenance, it just gets expensed. So here you have a truck. And you get the oil changed, you get new tires, you get new brakes. Those are all just normal expenses. So these are just all normal expenses. You know, you buy gas, oil, but whatever, you know, these are all just regular old expenses. Now, a betterment is something a little bit different. Color. Yeah, I'll make it invisible. Won't that be helpful? Okay, a betterment. This is when you actually improve the asset. And you improve it generally one of three ways. You make it more efficient, you make it bigger that can do more things, or you make it live longer. Okay, so these are what they call capitalized, and what that means is that they will be actually put into the cost of the truck. They will not be expensed. So these get added into the cost of the truck. So for instance, if the engine is overhauled, then it's going to increase the truck's life. Maybe the truck is going to last for 5 years, and I think it'll last for 10. Okay, you take that cost and you put it back into the truck. Upgrade the truck suspension so it can haul heavier loads. So now you got a truck that instead of hauling 2 tons, it can haul 3 tons or 4 tons or whatever. The truck is a bigger truck or a better truck now. And change the ignition system for better fuel efficiency. Now it's a more efficient truck. You capitalize it, you don't expense it. So normal routine stuff you expense. Things that are kind of unusual that will make it a better asset, you actually add those costs right into the cost of the truck itself, or the asset, whatever it is. Okay, let's do some problems. Okay, Omar Corporation paid $2,000 for a tract of land that had an old gas station on it. A new warehouse was constructed. I almost said werewolf. A new warehouse was constructed at a cost of $550,000. Okay, so the land. What's going to go into the cost of the land? The land was purchased for $200,000. So the purchase price will obviously go in there. What else will go in there?
The legal fees.
Yep. Yeah, so when you purchase the land, you know, the legal fees, you have the lawyers come in and do whatever the lawyers do. And those will all be part of it. There's one more thing.
Would it be the demolition?
Yep. We got to get rid of that old gas station so we can put our warehouse up. Now that's again, that's not actually part of the building. That the building will come up later, but that will be part of the land, and I think that's it. Yep. Here's my office. So this will be the total cost of the land. And you say, well, okay, well, who cares whether it's land or building? Well, the land is not depreciated. So, 20 years from now, you're looking at the books, it'll still show that land on the books for $34,000. Which is kind of a problem sometimes for accounting. I'll talk about that in a second, but yeah. I'll just tell you right now, one of the problems with things like land is someone bought land in 1964 for $12,000. It's still on the books for $12,000. Maybe today it's worth $12 million. And so you look at that and you go, well, this 12,000 is just a ridiculous number. It has nothing to do with, you know, the true value of this company, you know, because it's on that historical cost. There is a little bit of a problem with using the historical cost. One of the reasons why we like to use it is because it's a very objective cost. What did you pay for it? Okay, we paid, you know, in this case, 234,000. Okay, that's what you paid for it. Okay, we can go back, we can look at the cost, and we can say, oh, there it is, 234,000. Whereas the market is a little bit more vague, you know, it's worth 12 million, maybe like 10 to 14 million, you know, you get a little bit more of a vague number. But still, though, a lot of times you'll see that the actual number they have on the books is really so far outdated that it's not relevant. And that can be a problem in accounting. Okay. So this is going to be cost in land. And again, the thing is, this is not depreciated. Okay, cost of the warehouse. The warehouse was constructed at a cost of 550,000. And what other costs are going to go in the warehouse?
The architect fee and the interest on the loan.
And the interest on the loan is one of the kind of strange things, but it's part of it. And yeah, the idea is that, you know, that this is money that was incurred to it could have been used for something else, basically. All right, so total cost. The warehouse, and this is depreciated. So we split those costs up, and this 234,000 is going to sit on the books forever until we get rid of the land. This warehouse, though, you know, if it's planning on having a life of 20 years or whatever, we'll knock a little off the value of it for the next 20 years. We'll allocate the $613,000 out over 20 years or whatever it is. All right, any question on that? So these are just kind of the rules for putting something on the books. All right, let's go to depreciation methods. And if you had an accounting class before, you probably done this already. Okay, a couple things about depreciation. The matching principle is an accounting concept that dictates that companies report expenses at the same time as the related revenues. And this might sound kind of silly, but that really is what we're doing here. For instance, if you have revenues that come in during the year, let's say for 2023, you have revenues coming in. You say, well, expenses that come in, we match those up with the expenses for 2023, right? You don't match the 2023 revenues with the 17 expenses. You do it from the same period. What did we bring in this year? What did we pay out this year? So the matching rule simply says that the revenues and the expenses get matched in the correct period. So 2023 revenues will get matched with 2023 expenses. Kind of an obvious concept, but it has a few implications that we will talk about in a second. Okay, second thing. The depreciation process is for allocating the cost. So we are not trying to find what the value is of whatever the piece of equipment is. We're simply saying it's going to cost this much and it's going to last for this long. So how much goes into each year? So this is how much are we going to expense each year? So we're not trying to find, you know, if we're it's a silly one. But if we have a calculator, we're not trying to find the value of the calculator, but if we paid $5 for this calculator and it's gonna last for 5 years, you go, okay, well, every year we'll take $1 off the calculator. We're gonna spread it out, we're gonna allocate it over 5 years. We're not actually trying to find out what the market value for the calculator is. We're simply saying it costs this much, it's gonna last this long. How do we chop up that cost over, so that each year a little bit of it gets expensed? Okay. Probably the most intuitive method is the straight line method. And the straight line method is this. Let's see, the expected life of the tractor is 10 years or so. Okay, so let's look at this one. The straight line method, we basically use the years. So it's going to last for 10 years. And listen, let me just put it in here. Okay. So the cost was 300,000. Now, there's another important thing here, and that's this. The salvage value was estimated to be 20,000. So the salvage value at the end of its life, at the end of 10 years, is going to be worth $20,000. That's what we estimate. Obviously, we don't know that for certain, but that's what the estimate is. At the end of its life, it's going to be worth 20,000. So here's the question: they paid 300,000 for it. At the end of its life, it's going to be worth 20,000. So how much is this thing going to decrease in value over its life? It's going to go from 300,000 down to 20,000. How much is it going to decrease by?
280,000.
So what we're going to do is we're going to subtract out the salvage value, because we want to get the difference here. And this will give us the depreciable amount. Okay, so here is the amount that is going to depreciate by over its life. Okay. Now, if this thing's going to last for 10 years, how much are we going to reduce the price each year? Oh, you guys know this. So you take 280 and divide it by 10.
$28.
Yep. So what we say is that every year it's going to decrease in value by 28,000. And so this is every year for the next 10 years. And by the way, if you're wondering why they call this the straight line method, is that if you charted out the book value of this thing, it would start out at 280,000. Should I do it? Start over here. Start at 280,000, and then the first year it'll go down by 28. Next year it'll go down by another 28. Next year it'll go down by another 28, another 28. It'd be a straight line. So if you're to chart this out, the value of it, it would go down in a straight line. Every single year, 28,000 comes off. So if you chart it out, it's a straight line. But it really is just using the life in years is basically what you're doing here. And again, we're not trying to find the value of the truck. We're just saying it's going to decrease by 280,000. We're going to have it for 10 years. How much each year? And this is a really intuitive one for the most part. It's, yeah, most people say, oh, okay, if you didn't know anything about depreciation, you probably come up with something like this. Okay, now the actual nuts and bolts of how this plays out for the accounts is a little bit tricky. Let me show you why. The equipment is on the books at 280,000. Depreciation expense for the first year is 28,000. Accumulated depreciation is all the depreciation so far. So first year there's this one. Now the book value. Let me think how to do the book value so it makes more sense. The book value is kind of like this. Oh, that's gonna be a mess. The book value is the equipment minus the accumulated depreciation, and that equals the book value. Oh, I know how to do that. So 280,000 minus the accumulated depreciation will equal the book value. All right, so we have 280,000 minus. So that would be the book value at the end of year one. It's worth 252,000. It's worth 28,000 less than we paid for it. Now this next year is where it gets a little bit strange. The equipment stays on the books at the 280,000. Now intuitively you say, well, wait a minute. Shouldn't it be 252,000? It actually isn't going to be that, and I'll show you why. The depreciation for year two look like that. It'll be the same 28,000. The accumulated depreciation will be all of the depreciation up until this point. Oops. And just like that, I did it incorrectly. So this will be the accumulated depreciation. turn this into something you can actually see. Okay, so we'll have 280,000 minus 56,000. Ah. The arrow got in the way here. Okay, and then this will equal whatever that is. $224,000. And we just keep going on like that. Hey, copy that down too. That's good. So you go into the third year here, and it'll be all of these together. And this will just keep going on like this. You know. You could also just take this 84,000 plus a 28. That's another, probably a more efficient way of doing it. Okay, so you see the equipment and the accumulated depreciation. This is what gives you the book value, and it's just going to keep going down by 28,000 every year. This is why they call it a straight line method. Every year is going to get smaller by 28,000. Any question on that? Now, you might be thinking to yourself, well, why don't they just take it right out of the equipment? You know, that would make more sense. We don't do it that way. But yeah, but theoretically, there's nothing wrong with that. You know, somebody will say, well, why don't we just, you know, okay, take 20,000 right out of the equipment. Why do you have this accumulated depreciation account? And basically, it's that you have a little bit more information. You know what the item cost is. So, and that comes into play, especially like if you're going to be replacing it. You want to know what you actually paid for it. Whereas if you just see on the books for it's at, you know, year 10 is at 20,000. That doesn't tell you a whole lot about what it's going to cost to replace it. Okay. All right. So that is the straight line method. And that method is very common and it's intuitive. That, you know, just split it up evenly over the next 10 years or whatever. I don't know. These also I thought this was going to work out. You just keep the accumulated depreciation is all the depreciation. Okay, let's go to problem 3. Problem 3 is a little bit different. It's similar, but it's a little bit different. Okay, and here's kind of the reason why it's going to be different. The straight line method, if you use something about the same amount every year, the straight line method is fine. So if it's something that you use routinely for the same purpose, day in, day out, that's fine. But what happens if you have an asset that you don't use the same every year? For instance, a snowplow. Some years we get tons of snow. You use a snowplow, 2-3 times a week. Some years we don't get any snow. Like this year, we hardly got any snow. Maybe there are once or twice during the season. So you have this really weird thing where you have an asset that might not be used hardly at all one year and extensively used another year. It makes sense that the actual miles and all that you use on the truck, the actual depreciation of the truck should be for those years that you use it more. And in a business, a lot of times the years that you use it more, your income is more. So if you're running a snowplow business, the years we get tons of snow, well, that's where you make all your money. And it makes sense that you would match those costs up, that matching rule again, match those expenses up with the revenues that it generates. It doesn't generate the same revenues every year, so it shouldn't be expensed at the same rate every year. Okay, so it's when things are used in a, they're used for different amounts during the year. So we have this truck, and whatever this truck does. What does we say? Oh, tractor trailer truck, okay. Anyway, that it's going to last for 10 years or 700,000 miles. So what we're going to do is use the miles. Okay, the miles, so it's units of production, and the production of this is going to be miles. So we're going to use the miles for it. Now it's the same as we did before. In fact, I'm going to even copy just to save time. What is that? H14. I think these are the same. Maybe they're not. Why is it so far away on this one? It's so close on this one. Oh, the spacing's weird. Oh, I know. I put those extra spaces in now below. Okay. Oh, I can't do this. Okay, now, so the depreciable amount, 280,000. Now we're going to divide that not by 10 years, but by the 700,000 miles. So life in miles was 700,000. Oops. So we need to get the depreciation per mile. So we're going to divide this. $280 divided by 700,000. It seems a little bit low. Okay, so the depreciation per mile is going to be 40 cents. I'm gonna add rows here anyways. I'm gonna insert them right now. Okay, so what we're going to do is for each one here, we're going to take this 40 cents per mile. We're going to multiply it. Ah, okay, don't do that. Why don't it do? I'm going to put in 40 cents. How about that? Let's make it easy. Okay, so 50,000 miles times 40 cents You guys probably already got this. So the first year we're going to depreciate. Uh, So first year depreciation expense will be 20,000. Second year. 40,000, you can kind of see that we used it twice as much. So we expense it twice as much. And that brings us up to 360,000, but you know, this is just per year, so these would be the ones each year, and we still would have what's 700 minus 300, we still what 340,000 left of life on this truck. But again, you see, we use it for such different amounts every year, it makes sense to do it this way instead of the straight line method. So these would be the depreciation expense. It just hit me, I did this other one wrong. Oh my gosh, you guys, I gotta make a correction here. Rats, everybody, look at the first problem. This is stupid. We paid 300,000 for this thing. It just hit me, I did it. So make this correction. This is not my night, I'll tell you. Grab one of you guys. Change these to 300,000. So this is on the first problem that we changed 300,000. Also, we do this on the second one. These should be 300,000. The cost of it, not the depreciable amount. This is the amount we should have on there. What a stupid mistake for me to make. All right, so coming down here. So these depreciation expenses will look like this. So the first year will be like this, it'll be 20,000. Second year will be 40,000. Third year will be 52,000. And fourth year will be 32,000. Okay, so first it'll be 20,000. And this is a unhappy coincidence that that first one is the same as the salvage value. It's just, these two are not necessarily the same. It's just an unhappy coincidence.
How do we get the depreciation per mile again?
Oh, you take the 280,000 and then divide it by the 700.
Oh, okay.
I mean, here's a better way of showing it. So if you were to divide those two,
Mm-hmm. Yeah, that's better that way. Now I can follow it.
yeah, this is probably I should have done the other one too. Yeah, so if you divide it by it, so it's $280,000. You're gonna use it for 700,000 miles, so each mile. So this is the depreciation per mile. By the way, this is the method that the IRS uses too. So when you do your taxes, you guys start your own business or something like that, you'll keep track of your mileage in your car, and they'll let you depreciate a certain amount for every mile in the car. And so each of these, they could be different every year. It's possible they're the same. If you have 2 years that have the same mileage, it's possible they have the same, but usually they're not. They'll have something different. And if you do this method and they are pretty much all the same, it's possible you can say, okay, I'm just going to switch over to the straight line method because we're using the same amount every year, pretty much. Okay. So the next year we have 20,000 plus the 40,000. So again, this is just all the depreciation up until this time. So here's up to 20,000 plus 40,000 equals 60,000. Uh, 20 plus 40 plus 52 equals 112. You can also do this just by taking the one above it and then adding in for the new year. That's probably more succinct way of doing it. Yeah, it works out the same either way. It doesn't make any difference. The nice thing about doing it this way, though, is that you can. Oh, that doesn't work out. No, I did. So this accumulated depreciation just keeps going up and up and up. Now, here's how it's going to end up at the end of 10 years, or well, however many miles, at the end of 700,000 miles, this accumulated depreciation will add up to 280,000. And at that point, the value will be 20,000, the scrap amount, salvage amount. Okay, let's take a break. Let's see, D back. 707. if you go to that straight line one, make sure you make this correction. And I apologize for for stupidly putting the wrong numbers in there. It just hit me when I did this one that it can't be right. But anyway, the cost of it is what you should have on the books for the equipment. And it just sits there. And we have another account that goes against it that gives us the book value. So these on both these problems, this should be 300,000 for the equipment. Okay, let's go to the next one. All right, this one's a little bit confusing. Basically, investments are when a company has money. It doesn't make sense a lot of times just to have money sitting in the bank making, whatever, 2% interest or whatever, making in the bank. You take the money, you invest it. It could be investing in other companies. It could be investing in things that pay a higher return than, say, the bank, bonds or things like that. So it's when times you have money that you want to invest in other companies. It can also be that you're going to buy out another company. That's an investment too. So I think Microsoft bought LinkedIn a few years ago for 26 billion or something. So sometimes that you're actually buying the entire company up so that you can use, that's also considered an investment. So investments are when one company buys another company or tries to buy other securities to, and generally it's to make more money. I mean, that's the background. The underlying thing is that you want to maximize your return on your assets. So a lot of times you'll take money and I don't. This is one of the things that's kind of ironic. These accounting rules are kind of complex. Years ago, banks were having a problem with their investments. So they came up with all these rules. By the time these rules came out, they applied to everybody except banks. So it was kind of a weird thing that a banking crisis caused these rules to happen. But then by the time these came out, the banks had kind of settled their rules out, but everyone else had to follow these rules. So these are kind of it's kind of a strange situation. That's how they came about. And in the book, they talk about trading securities, which are only for debt securities. They can be sold at any time. So if you have a debt security that, for instance, you buy a government bond, they have markets for government bonds. If you're going to sell the government bond at any moment, then it's a trading security. It's actually a fairly rare situation, but anyway, they talk about it in the book. Equity securities, when they invest in stock. So if you have IBM and they buy stock in LinkedIn, these are the rules that apply. They're buying out the company. So up here, they're just basically loaning money. Up here, they are actually buying the company. They're down here, so they're buying the company. And we're going to focus on the ones in yellow. I don't really think we have to go too far into the other ones. It doesn't really matter too much. But basically, when you talk about equity stocks, this is if you're not completely in control of the company or have some control over the investment, it's probably here this fair value method is the one you use. And in the book, they talk about trading securities. And so the trading securities are the same as the fair value ones. These are actually the exact same accounting. Now, the trading securities nowadays are actually fairly rare. They used to be more common. Now they're not. All right, let's go to a problem. These are not that difficult because you might think. Okay. So we have these securities And this is what your problems look like for this one. So we have these securities and they have a cost and a year-end value. Now, we are not selling the securities. We have them on our books as what they call a portfolio. We have all of our investments. Now, at the end of the year, usually from a brokerage place, we get a listing of, of the values of these investments. You don't know whether you made money or you didn't make money. Now, it doesn't mean you actually sold them at the end of the year. You're still holding on to them. So that's kind of the idea behind this, is that these are actually changes in the value of them. Okay, how will the changes in the securities affect net income? Okay, well, we have to see. All right, so this first one here, put it down here. We have a cost, total cost of these of $695,000. At year end, the value is $745,000. So we paid $695,000. At year end, there were $745,000. So, do we have a gain or a loss? Anyone? We paid this much.
Is it a gain?
Yep. Yeah, we gained what is that, 50,000? So 745 minus. So this will be a gain. And we will call this an unrealized gain. I'll tell you why in a second. Oops. It's unrealized because we haven't actually sold the stock at year end. Now, a lot of times for stocks, you can sell stocks in a lot of times, a few minutes. So you could quickly turn that into a realized gain if you needed to. But it's an unrealized gain because the stock is not sold yet. So that's why it's unrealized. If we were to sell it, it would be a realized gain. If we actually sold it for that, we just have a plain old gain. But because we have not sold it, it's an unrealized gain. So down here, we will have an unrealized gain of $50,000. Okay, number 2, what would be the effective income if the Nichols Incorporated securities were worth $280,000? I'm going to copy all of this. Let me copy it down here. Okay, so they're saying, what would it be if the Nichols is 280,000? So I just changed this number. All right. Well, in this case, we would have a loss. So this would be an unrealized loss. Okay, so these are, when you see unrealized loss, that means that you haven't sold it yet. But in this case, we've lost money on the investment, but we haven't sold it yet. Maybe we think it's still gonna go up. That could very well be what they're planning on. Okay, let's go to the last problem. Okay, I think I got this laid out the way the book has it for the problem. And I think I'm gonna change it just to make it make more sense. Because actually, if you look at this investment. You talk about the cost of it. Well, the cost must be before 2020. So this is actually should be, the furthest one away. Yeah. So I'll leave it there, but I'm gonna copy it over to here. Maybe that's confusing. No, I don't know. I'm gonna get it out. Okay. So the cost of it was, so down here we'll put the gain or loss for each of these. Okay. So this first year. So this first year, do we have a gain or a loss for 2020? We paid 19,800 at the year end. It was worth 19,900
Again,
gain. Okay, let's go to the next two. So in 2020, these had a value of 19,900, and in 2021, the value had dropped to 18,300. We have a gain or loss?
Loss.
Loss. The loss was 1,600. And then we have it recovered. It would get back to 19,200. So we have a gain or loss for 2022.
gain.
So that's what things would look like down here. On this problem in the book, though, and again, notice that I think they have the cost at this end, which chronologically is, I mean, it's not that it's wrong, but I think it makes more sense just to put it as the oldest. This is what we paid for it years ago or whatever, or in 2019 or whatever it was. So if you put it in this order, it kind of makes a little more sense. Question? That's it for that one. Yeah, so these aren't too bad. The only thing you notice, if you remember that this is unrealized. Unrealized gains and losses. That they have not been sold. If they've been sold, to be a regular gain or loss. So if you actually sold all these securities, you'd have a regular gain or a regular loss. But because these are unrealized, they have not been sold. Okay. Well, we have more time. If you want to, we can start working on problems from the homework, or you just call it a night too. If you think you got it, you're sick of seeing me put wrong numbers up. Chapter 7. I can pull it. Let me take a look. Share my screen here. Oh, I have a question. Oh. Oh, quite a bit below. Let me take a look. Oh, you're right. Ha! Well, actually, I imagine that was a leftover from something because. Yeah. Let me show you. First of all, it can't possibly be the right one for this one. I'll show you why. I only give you for 4 years. But let's change this. I think I meant to. I don't know what happened. That's kind of a cut and paste problem I did. But let's change this from 5 years to 4 years, so we can talk about it, because these are all 4 years. I bet you the problems are 5 years though. I probably cut and pasted those from. Okay, so let's say for 4 years. Let's go back for 4 years and see which one had the higher total depreciation charges. Okay, so let's do this. So straight line. The accumulated depreciation. Straight line accumulated depreciation was, again, of 4 years, 112,000. So which one has a higher? This one. Ah. So it'll be higher in this case under units of production. It doesn't have to be though. I mean, it is possible that you don't use it as much. And then it would be less. But in this case, which one gives you the lowest? I imagine this comes right out of the problem. It probably says 5 years in the problem. But I only did this for 4 years, so we only use 4 years. Is there one down here? Hey, you're right. It's on both of them. And this one asks it before you even have done the other one. Pull out the crystal ball, see which one. Sorry about that. Yeah, so the accumulated depreciation would be higher for units of production.
Professor, I have a quick question.
Yeah.
So it's nothing about the lesson today, but just in general, I linked my business course and my Blackboard, but none of the grades are syncing, and I don't know if that's what they're supposed to do with the link in between them, or if I did it wrong.
If you clicked on it, went through Blackboard.
Yeah, I went through Blackboard and I clicked like the link, and then it had me log in. So I logged into my business course like through that link that you said to click, but no grades populated into Blackboard. They're still all in my business course.
Mine still hasn't either, and I linked it a couple weeks ago.
Okay, give me 1 second. Let me pull it up. And unfortunately, I can't. Well, I can show you what I'm doing up until I get to the grade part. I can't show you other people's grades, but I'll see here.
Yeah, and then I clicked login.
Let's see here. And I'm going to do something. I'm going to. Yes, I'm going to do the integration thing and resend all grades. Now I gotta stop sharing because I gotta look and see if the grades are. I shouldn't have to do the resend the grades, but
The only thing showing up on Blackboard is the extra credit for me.
yeah, those are.
But none of my business homework is showing up.
Right, I gotta look at one more thing in the. You know what? It might have something to do with the email account. See if you can, in my business course, you can change your email to the Roosevelt email account. I didn't think of that.
It is already my Roosevelt email.
Yeah, mine isn't, so I don't know if that's the issue. Mine is my personal email.
Okay, I'm sorry, I didn't catch you. Who had it already in there?
Mine was already in there as my school email.
Okay, let me take a look. Yeah, it is. And you went through the thing and you went through clicked on the My Business link?
Yes, 2 weeks ago I did it.
Huh. Well, let me go ahead and send I'll send another email to them. They're not there right now. They leave at like 6. But I will I'll send it again to them. I'll ask them to take a look because that people have gone in, and you're right that that I'm not even sure that the email thing is a problem since it's having to both of them. But let me contact them. It's a small group, and for whatever reason, for some reason, my classes have gotten screwed up with them. And I think it goes way back to when they, like 3 or 4 years ago, they sent me a link that I could go in and as a student into another teacher's class, which I never did. But anyway, they had my email signed up as a student, which meant that I couldn't link classes and things like that. So I'm wondering if that's still part of the problem in all this. And again, it's kind of a weird thing, but when we were trying to link up the classes, that was actually one of the problems. But let me send another I'll fill out another work ticket tonight and send it into them because obviously we want all those grades to come in. And I think what I'll do though in the meantime, is I can download the grades and I'll enter them manually. So any ones that are not being sent over, I'll do those manually. But I will also want those to be linked up so that when you finish an assignment, it should immediately be the Blackboard.
Right, yeah, that'll be good, so we can know that you have received it.
Well, I
Do the work, yeah,
I can see all the grades.
okay. So does it show you if we have done the homework and turned it in?
No, it does. In my business course, I go in there and it shows everything.
Okay,
Let me check one thing just to make sure.
And for the extra credit,
Yeah, now the extra credit doesn't go through my business course. That'll just be,
like an upload.
yeah, that's just in Blackboard only. You know, Patricia, it's still showing you a different email.
Mine is my personal email. I think Caitlin was
Oh, Caitlin, I'm sorry, right.
her
Oh,
school.
no, you know, Caitlin, yours is right. Man, is that strange? Let me, I tell you what, let me, you mean nasty messages in Zoom. Let me contact them and see if they can figure out what's going on. And I will let them know that you guys have gone through, you know, you clicked on the My Business course on Blackboard and it's still not integrating them. It's kind of frustrating. It's a little group and they're good people, but it's not all worked out yet. And again, I think it goes way back to when they signed me, and I didn't even ask to be signed up in it, but they signed. They said, "Hey, you know, Mark, you're going to be teaching this, so we put you in this class." Well, from then on, I was a student. So anyway, I will send it. I'll fill out a ticket tonight and send it in, and in the meantime, I'll download the grades and get those in as soon as possible into Blackboard. But hopefully, they'll start updating automatically. That's the whole point of it. So, all right.
Thank you.
Yep, thank you.
All right, well, have a good evening, and I will try to get this worked out. And I'll see you
Okay.
next time. Bye.
Bye-bye.
Thank you.